All right, I got to tell you, well, before that, let's go through introductions. I'm Mike Weber. I'm one of the tax partners here. GYF, I've been here for 15 years. I think this is my 21st tax season, or coming up on my 22nd tax season. And co-presenting is?
Hi, I'm Lisa Wiegand. I am a senior manager here at GYF in the tax services. I've been in the industry for about 17 years, with GYF for about 2 years. Anyone that has been here, that was here last year, may recognize me. I was one of the MCs last year. I did a lot of the introductions for the folks before they presented. This year, I don't know if you've noticed, but we don't have MCs this year, and I'm trying to decide if I should take that as I was so hilarious and I did such a great job that they just retired it on a high note, or if it was just that bad that we're just not going to do that again. But either way, I have been promoted to presenting, and I'm excited to be here today.
All right, and as I'm sure everyone could appreciate, this is the absolutely worst spot to be in when you present. And I got to tell you, it's not because of lunch, though. We had to follow a great Mr. Rogers presentation, head, shoulders, knees, and toes, get the blood flow and everything. Dawn's red sweater, we had to watch that. Of course, lunch. We're before the cookie break. I mean, I'm expecting Mary Lou to come up here and to say we're going to give a car away or something at this point, just to throw. Okay. All right. So here's what we're going to do. We're going to cover something like 6 to 7 different state tax topics today. This is a tough crowd. That's only the most popular things that kids say these days, That's all right. I know what you're all thinking too anyway. Did he just say 6 to 7 different state tax topics? Like how long is this session? Don't worry though, don't worry. Next time you're thinking about 6 and 7 is how many slides till the end. There's 45 slides, you do the math, okay? All right, so Mr. Rogers taught us to be good neighbors, right? Which is perfect because today, in this presentation, we're basically talking about state neighbors and how all they want to do is tax your dollars.
All right, so before we dive in and get started, I'm just going to give an overview of the discussion points that we're going to go over today. Most of them are going to relate to Pennsylvania, but we will be talking about some other states as well. So the first topic we will cover are 2025 Pennsylvania updates, and we have a variety of topics that fall under there. Next, we will talk about federal to PA nonconformity. So these are the differences in how things are taxed for federal purposes versus how they're taxed for PA purposes. Followed by Public Law 86-272. This is a pretty heavy topic, so we won't be going into much detail because that could be a full 8-hour session itself. But for those that are not familiar with Public Law 86-272, it essentially is protection for companies that are entering into other states for the sole purpose of soliciting sales for tangible property, and it protects them from having to pay income tax in those states. Next, we will be defining what domicile versus a residency in Pennsylvania is, and going over some examples. And lastly, we will be talking about tax adjudication in Pennsylvania and walking through the different levels of appealing tax in Pennsylvania. All right, so to dive right in, PA corporate net income tax. So this is a tax that C corporations pay in Pennsylvania if they're organized in PA or if they're doing business in PA. Entities that would be exempt are not-for-profit organizations, homeowner organizations, and membership organizations. Now, to give a little bit of history, PA has historically had one of the highest corporate net income tax rates in the United States, and so it really deterred some businesses from doing business in our state. So back in 2022, it was enacted that we would gradually reduce that rate starting from 9.99% in 22, gradually down to 4.99% in 2031. So for 2025, we're at 7.99%. All right, Senate Bill 206 and House Bill 1742. These bills were introduced earlier this year, January and July of 2025. And they were to amend the Tax Reform Code of 1971. They were introduced to eliminate the state income tax in Pennsylvania for resident individuals, estates, and trusts, which is rather shocking. You would think something like this might be, heard about more in the news. So I did a little bit of digging to find out, why isn't this more of, a bigger issue that we're hearing about? And it turns out this is not the first time something like this has been introduced, but there's really no traction. So the likelihood of it actually passing is pretty slim. But if it did pass, it would be effective immediately, and then employers would no longer be required to withhold income tax on those individuals that were not required to pay. All right, NOL carry forward limitations. So a net operating loss are losses that are generated by a C corporation that aren't able to be used in a certain year, and so you can carry them forward to be used in a future year. Pennsylvania caps that usage at 40%, so you cannot offset more than 40% of your taxable income in Pennsylvania. Senate Bill 654, which was passed in July of 2024, will gradually increase that limitation by 10% each year. So we're starting at 40%, and by 2029 it will go up to 80%. And that 80% is in line with what the federal cap is as well. And there is a 20-year carry forward period on that. And Mike is going to share some case examples for us.
All right, so how did we get to this point, though, with the 80% cap? Well, 40%, and then it's ratcheting up over the course of the next couple of years. Well, just like anything, every business is trying to look for an angle, and so they challenge the system, and so you have a litany of cases that make their way through the system, and then the legislature has to react to that, and so, based upon these next three cases we're going to talk about, is how we landed on this 80% number. In the first case here, this Nextel Communications case, this was actually the year at issue here was 2007, and I think 2007, that was the year I graduated at college, so I don't know who was paying attention to the code back then, but I don't think it was me. The rule back then for PA NOLs was actually that it's the greater of $3 million or 12.5% of your taxable income. And this entity actually had $150 million of losses that were pulling forward. And in 2007, they had $45 million worth of income. So of course they could only deduct, the 12.5% number, which was $5.6 million. And they actually challenged this, took it all the way up to the PA Supreme Court, and they weren't challenging necessarily the 3 million or the 12.5%. What they were saying is that by doing this, you created two different kinds of taxpayers, right? Somebody that was beneath the 3 million had one set of rules, and if you were over the 3 million, you had a different set of rules. And based upon, I don't know if you know this or not, in pretty much every state's equivalent constitution, they have something in there called the uniformity clause. Like every taxpayer has to be treated in a uniform manner. And so the PA Supreme Court required that they sever one of those metrics where you're measuring. So based upon that, they basically went with the certain percentage of your taxable income. Next came two different cases based upon that reality, where in the first case, General Motors, this is dating back, the year in question here was actually 2001, but you can see in parentheses there, they were essentially challenging all this in 2021. And in 2001, there was a $2 million cap on losses, and in this entity had about $200 million of carry forward losses, and in this year in question, they had somewhere in the neighborhood of $9 million worth of income. And what they were requesting from the court system is to allow them to go back retroactively and claim that refund. Even though in the previous case that had been decided in 2017 that you couldn't have both limitations, they were saying, well, okay, now that we know that, let's apply this retroactively back to that year. And actually the PA Supreme Court was actually on board with that, and they allowed that to happen. But in 2024, you had this pretty much the same case happened dealing with the 2014 taxable year. And in this case, this particular entity had somewhere in the neighborhood of like $800 million in losses. It's a lot of, I mean, all these cases, how's anybody in business? A lot of losses here. The cap was 25% or income of up to $4 million. And they were trying to get that relief retroactive. And essentially what the court said in this case is, yeah, which they don't really like to do, for any of you that follow some of this stuff, they don't really like to go back on their word and say, yeah, you know what, we really blew it in the previous case. But you think about what's the dollar magnitude of going back and issuing all these refunds for people that are going to claim them. I mean, you could be talking about, hundreds of millions of dollars of refunds. So they actually reversed courses in that case and said, yeah, we're still going to keep the same rules in place, but we're only going to allow businesses to apply them prospectively, okay? So you couldn't go back and claim these refunds. So where does that leave us? Like Lisa said, essentially, because of all these things that happen here, we're dealing with a situation in PA where it's only a percentage cap, okay, ratcheting up to 80%. But it's because of these cases that have come before us as to why we have the rules that we have right now.
Thank you, Mike. All right, we're going to move on to Pennsylvania Annual Report. Again, those of you that follow along with us and were here last year, we had a whole session. Becca Flanders on our team had a whole session on the Pennsylvania Annual Report. It's a new filing. We've sent out a ton of emails. We have posts on our LinkedIn. If you are in any way connected to GYF, you have heard from us about this report. So we're just going to quickly go through the new filing requirements. It's effective January 1st, 2025. It is for both for-profit and nonprofit organizations. It is an informational report, so it's very quick, very easy to complete. It's really just the name of the business, the address, the officer names, officer titles, and addresses. Shouldn't take more than a couple minutes to complete. Failure to file will be subject to the association being dissolved or terminated, cancellation, or a loss of protection of its name. However, PA is giving us some leeway in that they will not start those repercussions until the annual reports that are due in 2027. So the deadline for this filing is June 30th for corporations, September 30th for LLCs, and December 31st for LPs, LLPs, and business trusts. To file, you would go to file.dos.pa.gov, register for an account, complete the report. Like I said, it shouldn't take more than a few minutes, and then there is a $7 filing fee associated with that.
Yeah, we actually have an article on our website that walks you through how to do all this. And I know we talked about this last year and what seems like the year before that. This has been something that's been coming for quite some time. I did actually, you might find this interesting, I did actually look this up on the Department of not the Department of Revenue, but the Secretary of State website. Here's what they say they're trying to achieve. This is what they say for the annual report. They want you to, these were bulleted, maintain current business information. They're looking for public transparency. They want to have administrative oversight and compliance. They're looking to transition to an annual requirement, which we just talked about. I think prior to that, at least from what I can tell, was, I think the word's decennial. I think that was what the requirement was prior to this annual. The facilitation of reinstatement and name protection. The fact that there will be no financial disclosures as it relates to this. The filing would be easy. Now I got to tell you, the amount of phone calls that we got, the filing is not easy. They say it's easy, right? Click here, boom, you're done. It's kind of like getting that $20 Google credit, on YouTube for YouTube TV. Click here, boom, you're done. Doesn't seem to want to go that way. We're getting a lot of calls on that. I think they can make it a little bit easier. And they also actually said on their website that, don't forget, this is different than like all of the iterations of the Corporate Transparency Act that was on, off, on, off, on. I don't even know where we're at with that right now. I think it's off at this point. So they did it. The Secretary of State outlines all those things on their website. That's what they're trying to accomplish with this requirement.
All right. Whoop. Moving along to grantor trusts. So a grantor trust, for anyone that is not familiar, is a type of trust in which the individual that creates it, they still maintain certain powers and control over the assets that they place into the trust. And because of that, they are considered the owner of those assets and the income that is generated from those assets for income tax purposes. So for federal purposes, historically, the income generated in these trusts would be reported directly on an individual's tax return. PA, however, did not recognize grantor trusts. And so in this instance, taxpayers would need to file a separate PA trust return for these trusts and not have to file one for federal purposes. But that has changed. So effective January 1st, 2025, PA now recognizes grantor trusts. So folks that have these trusts are no longer required to file a separate PA tax return. All right, last 2025 PA update for you relates to Philadelphia BIRT tax, which stands for Business Income and Receipts Tax. And we have a lot of clients that do business in Philadelphia, and maybe some of you here today do business in Philadelphia. Historically, there has been a $100,000 exemption on this tax, and it's a pretty hefty tax. It's at 5.81%. So you could exclude your first $100,000 of sales in Philadelphia. That exemption is now going away. So it's just something to be aware of. And if you have less than $100,000 of sales in Philadelphia, you may be now required to file. All right. We are going to move on to federal to PA nonconformity. So the first topic we're going to talk about, is net operating loss. So we kind of already went over PA. PA is currently at 40%. It's slowly being increased to 80%, like I mentioned. Federal is already at 80%, so they will be in conformity at the end of PA's few years here. The one difference that will stay is PA will have a 20-year carry forward limit, and for federal purposes, it's an indefinite carry forward period. Depreciation, as Dawn had talked about earlier, federal purposes, there is 100% bonus depreciation. Pennsylvania and a lot of states do not allow bonus depreciation, and so for PA purposes, that expense is actually added back, and then those assets will then be depreciated over straight line or makers or by using 179. All right, meals and entertainment. So for federal purposes, most meals are deductible at a 50% rate. For PA purposes, you can claim 100% of those meals. And entertainment for federal purposes is 100% non-deductible, whereas for PA, you can deduct those entertainment expenses. All right, section 174. So again, Dawn spoke about this earlier from a federal perspective. So just to summarize briefly, for federal purposes, in the last few years pre-OBBBA, for federal purposes, we had to capitalize those expenses and amortize them over a period of time. PA did not have that requirement, so you were able to fully expense those items in the current year. So, for the past few years, we've had that difference between federal and PA. Now that PA or federal will be allowing the full expense, we will no longer have that difference. And it's really just something to keep in mind for those folks that are doing 2025 and 2026 planning, thinking, I have this great deduction that I can take for federal purposes, but just planning ahead, knowing that you're not going to have that expense for PA purposes because those expenses have already been deducted. So just being familiar with that and recognizing that and planning for that is important. And then I'm going to pause here. Mike and I have an example that we'd like to share with you related to this and related to PA. So we have a client who received a PA tax notice, and there were a couple adjustments on the notice. One related to accrual to cash adjustment. We agreed with that adjustment. Another adjustment related to these R&D expenses. We had deducted them for PA purposes, but on this notice, they disallowed that deduction. And it impacted the business and all of the business owners, and it was over multiple years. So it was a process for us to go through, and we went through the Board of Appeals, which is the process that we'll talk about a little bit later. But it was a process for us to get through with PA and the Board of Appeals and get this approved. And the funny part is, at one point, PA was pushing back on us saying, no, you can't do this, you can't deduct these for PA purposes, and we kept pushing back, no, actually we can. And it got to the point where they actually asked us to provide proof. Where did you read this? Where did you find this? And so we literally had to go to the PA website, print the FAQ that said that we can deduct this, and provide it to PA. And we were able to get it approved at that point. So it's just interesting how, the folks that we're working with, in PA or in the IRS, they don't always know the tax law. So don't take tax notices at face value. Reach out to your accountant, reach out to somebody that can help you, because a lot of times we know the tax law better than they do.
Yeah, I think what was even more just absurd about that is there were 4 different shareholders of this entity, and we were trying to amend their returns for different reasons too, and we couldn't get those through until the underlying S Corp was approved, and we had sent in information to the Department of Revenue. They're sending us letters, well, you can't amend this return because this thing's hung up at the Board of Appeals, and of course we're saying, yeah, no kidding, like we're just trying to get this through based upon what the actual rules are. I mean, it took, I don't even know how long this took.
Months.
I mean, months, yeah, months, to ultimately get to the point where, proving to PA that we were correct, right, in everything that we were doing. And it cost time, money, aggravation, the clients, when's this going to be done? And of course, we don't have an answer to that. We're just relying upon, PA to move as fast as they can move to try to get this resolved. So, I mean, it's just, when you're going through a situation where, perhaps you're wrong, or there's like a gray area or something, that's one thing. When you're just like 100% right, and then this happens, that's a lot to stomach.
All right, next up, we're going to talk about 163J, business interest expense. Dawn had mentioned that it is limited for federal purposes. It's limited to 30% of your taxable income. PA doesn't have a similar limitation, so you can fully expense business interest for PA purposes. And the last one I'm going to talk about for nonconformity relates to GILTI and FDII deductions. Again, this is a topic that we could talk about for hours, but these are federal deductions for businesses operating in foreign countries, and those would be disallowed for PA purposes.
Yeah, for those of you that are familiar with looking at some of the tax returns, you have this schedule, what M I think it is for PA, that has all the differences. I mean, these are some of the items you would see on there. But every state's different in what they do. You might go down to West Virginia, Ohio, or North Dakota, and their rules on this are going to be different. Some of them just adopt whatever the Internal Revenue Code is. They just basically say whatever the federal government says, this is the way that we're going to be, right? And some states do that. That would be easy, right? But then, I guess, what did Dawn call it? The creating extra jobs for tax professionals or whatever it is. Like, we definitely want the states to be different, create all those differences, schedules, right, that we have to fill out for each state. We actually have, a couple of different, research providers that you can go in and take a look and say, all right, what are all the differences between federal and PA? I mean, you're printing out, a booklet worth of stuff, federal to West Virginia, you're printing out another booklet worth of stuff. So, this is just Pennsylvania, but, recognize and appreciate that, other states are going to have their own set of rules, and they're going to be different than what we just talked about. All right, we're going to move on to a more juicier topic. Public Law 86272. Just by a show of hands, does anyone even know what this is? How many people know what this is? A few, okay, so 2.5, I think we have what this is. All right, so everyone should be paying attention here. So many of you know, I went to law school at Duquesne, never wanted to practice as an attorney. I always wondered though, like if you made it to the pinnacle of your career in the legal profession, you're like on the US Supreme Court, and when you retire, just imagine all these guys sitting around the local, tavern, watering hole, and they're discussing the cases, the monumental cases that they decided. in their lifetime. They're like, yeah, what were you? Oh, yeah, that's right. You were the Brown versus Board of Education, big deal, right? Marbury versus Madison, another big deal. McCulloch versus Maryland, all big deal. Who's the poor lonely soul that says, by the way, I was Northwestern States Portland Company versus Minnesota, 1959. And if a case makes it to the U.S. Supreme Court, it's got to be like unbelievable, right? Awesome. So you can just imagine all these justices sitting on the edge of the seat. Well, tell me about that. What was that case all about? State income taxation. That's a riveting topic, right? So in this case, back in 1959, actually the years in question of this case were like 1933 to 1948. Essentially, what you had is a corporation that was operating in Iowa. Yeah, it was Iowa. And essentially they were sending their people into Minnesota, essentially sell their product, do a variety of different things. And Minnesota back in these years said, well, you're sending your people here, so I think we should apportion some of your income to Minnesota and you should have to file an income tax here. And lo and behold, that's what the U.S. Supreme Court decided, that yeah, Minnesota could do that. So then, of course, Congress got wind of this, right, and said, you know what, I'm not exactly sure that that's the way we want things to be. So what they decided to do is pass the Interstate Income Tax Act of 1959, which is otherwise known as Public Law 86-272. What this essentially does is that it provides very limited protection or limited immunity for an entity that is doing a very small thing within a particular state. And if you're doing that very small thing, you will not be subject to that state's income tax. Now that doesn't have anything to do with nexus. We had a heated debate, and as much as a heated debate could be amongst CPAs, we had this debate a couple weeks ago about what actually does 86-272 provide for you. It doesn't answer the question about whether you have nexus in a particular state. It just gives you immunity from that state's income tax. And if all you're doing is soliciting orders for tangible personal property, you're not subject to that state's net income tax. So, you think about that economically. Okay, we can send people in, they can do a certain number of things. We're not going to have to file 28 tax returns. We're just going to have to file our home state return. I mean, that's basically what they were trying to accomplish here. It does give you uniformity. The other thing, though, is it requires that you still file a tax return. So like in this case, in the cement case, they still would have had to have filed a return in Minnesota. But for anybody that does state income tax, you'll note that sometimes there's a little checkbox, the front of the return, page 3, page 28, wherever it is, it says, you're availing yourself of 86-272. You check that box. And no income tax pops out, but you still have to file the return. Some states don't have it. You got to attach a statement. There could be better uniformity with respect to that. So what's happened over the course of time? Well, of course, there's been, a whole number of cases that have come out that said, well, we're just sort of like stepping over the line just a little bit. And if we do that, do we still get to avail ourselves of this rule? Well, the answer by and large is no. I think Don told me one time that if you sneeze in a state, you're in there, right? And that joke's not as funny anymore after COVID, but if you sneeze in a state, you're in there, right? Well, in this case here, in this South Carolina case, essentially what was happening here is this was a company that was organized in Connecticut, and they had one employee that was situated in South Carolina, and that employee was going around and selling alcoholic beverages. That's the way they put it, alcoholic beverages. I don't know if it was beer, I'm not sure what it was. Alcoholic beverages is what they said. But part of what was required under South Carolina law was that in order to sell an alcoholic beverage in South Carolina, the title had to pass in South Carolina. And so if you go back and look at like the basic rules under 86-272, it says that the order essentially has to be approved out of state. Well, in this case, it's approved within the state. And these guys were saying, well, wait a minute, just because the state requires us to do this, that shouldn't mean that we have to pay income tax and not be able to utilize this rule. And the court system didn't like that. They said, too bad. All right. I would say probably the most famous case in this area, as much as you could be famous for 86-272, it's this Wrigley chewing gum case. Now, I have a lot of questions about this case. And no, this is not the gum that Danny Smith chews. I found out that's like double bubble. That's what he chews. I saw that the other day. It's not Wrigley chewing gum. Well, Wrigley had employees that were operating in Wisconsin, and they were doing more than soliciting orders. They actually had inventory with them, up to $1,000 worth of chewing gum that they could go into stores and replace if the chewing gum that was in the store became stale. And that's where my question comes. How would you know if chewing gum is stale? Would you have to open it and chew it? But then how do you put it back on the shelf? I don't understand. I guess there was like an expiration date on it or something, but because they were doing something merely beyond soliciting orders, they were stuck. They were subject to Wisconsin's tax. And look, all these cases that I have listed here are all pretty much going to follow the same thing. This Miles Laboratory one, this one's unbelievable too. Same sort of basic situation where, entity in one state doing something else in another state, same thing. These guys had some inventory that they could replace from time to time. And actually in this case, they were saying that the value of the inventory they were replacing was a measly $10. That was also enough to push them across the line. So you got to be careful. It's an important thing, something that you could avail yourself of, but make sure you're only soliciting orders. All right, so why is that important? Why is all this important? Well, for those of you that deal with multi-state taxation, especially in the C Corp world, you're probably familiar with some of the concepts that are on this slide. And this is why I go back to what I said at the very beginning. What does 86-272 actually mean? What it actually means is that you have that limited immunity. It has nothing to do with whether you have nexus in a particular jurisdiction. Because you have nexus in that jurisdiction, you can actually take a look at these throwback and throwout rules as they relate to the state in which you're officially sort of domiciled in. So for Pennsylvania, we don't have a throwback or a throwout rule. Essentially what that means is we get to keep those sales inside of those states where we have nexus, but we don't have an obligation to pay income tax, right? And that really helps C corporations here in Pennsylvania end up with what they call nowhere sales. That's the last point. Essentially, you have sales that are happening, they don't get taxed anywhere. We don't pull them back into Pennsylvania. So all these things are important. I probably have, a dozen or so clients that actually claim this exemption in a variety of different states.
All right, so now that we know the history, we know what Public Law 86-272 is, we know the history of it, we're going to talk about some updates. So the law was created in 1959. The way we do business is just not the same as it was in 1959. So in 2021, the Multi-State Tax Commission issued some updated guidance, and it essentially says that if you're interacting with a customer in another state via the internet, you are considered to be doing business in that other state, and you may be subject to income tax in that other state. Now, it does provide some activities that are protected and some that are not protected. So those that are not are providing technical assistance via chat or email, enabling cookies for marketing or inventory purposes, soliciting business-specific online credit card applications, and out-of-state residents applying for non-sales positions from the website. So I really interpreted this as it's any time that you're being more interactive through your website, that could be deemed to be doing business in those other states that would require you to potentially pay income tax in those other states. And now what is protected is having a static FAQ list on the website and enabling cookies used for purposes solely related to the solicitation of orders for tangible personal property, such as remembering items in a cart, storing a customer's personal information, and reminding customers of items considered during previous sessions. So So as you can imagine, a lot of states, had some responses to this. The usual suspects were fully on board. California, New York, and New Jersey, they jumped on the idea of, yes, we want the income tax on those sales. So they did implement the guidance. California quickly avoided it. New York, it's being challenged in at least one county, and New Jersey just provided additional guidance, ruling that the nexus must be established prior to the interpretation of the MTC 2021 statement. So here, this slide just gives us just an overview of the states that are explicitly not following this statement: New Mexico and Oregon. States that are informally following this statement: Kansas, Utah, and Alaska. And states that are considering formal adoption are Colorado, Minnesota, Maine, and Tennessee. All right, so then we're going to fast forward to 2025. In 2025, the Interstate Commerce Simplification Act, it's a proposed act that would expand the definition of solicitation of orders. So while the 2021 Act would limit the protection, this just adds another layer of protection back on. So it essentially expands the definition of solicitation of orders to include additional business activities that may serve an independently valuable business function apart from the solicitation of orders, but you would still get another layer of protection. There's not a whole lot of specifics on what this will look like. It's still proposed, so hopefully we will have more information to share in the future.
Of course, remote working has become a thing since 2020. Well, even before that, I guess some people worked remotely, but as a result of COVID, obviously there's more and more remote working, whether it's just remote in as much as you live in Pittsburgh, but you don't come into the Pittsburgh office, or you're a remote worker that lives in Arizona and you work for an entity that's in Pittsburgh. They actually go at great lengths to say that's not called remote working. That's called telecommuting. In this Telbright case, they call it telecommuting, if you can believe that. It's not remote working, it's telecommuting. Essentially what happened here is that you had a Maryland corporation, but they had a New Jersey employee. That New Jersey employee was a software developer, and they were spending 100% of their time working from home, and just from New Jersey. And this entity was actually withholding New Jersey state income tax for this individual, right? And this individual was filing a New Jersey personal income tax return, but the business itself wasn't filing a business tax return. And they're just, basically just trying to say, look, this person's telecommuting, so we really shouldn't have anything, you really shouldn't have anything to latch onto. Of course, pretty much have to be living under a rock at this point to know that that's really not the case. You have employees doing certain things like this, developing software in another state that's going to pull that business into there. They did go on to say, though, in this case, which is pretty much, even though it's a New Jersey case, pretty much like the leading case with respect to remote workers right now, they did basically say that, look, the reason why this matters is because you have, they say, regular, continuous telecommuting, all right? But they didn't address really the infrequency type work. So there has to be some threshold, right, of time that you're spending out of state before that state can pull that business in. In this case, this person was working, 2,000 hours from home, clearly beyond the infrequent nature. So another thing that's popped up more recently, doesn't really have much to do with 86-272, but kind of fit in here. And if you'll note back because I know someone's going to say afterwards, your slide at the very beginning only had 5 topics on it, so this is the 6th one, so we could get to the 6-7 part. So this convenience of employer rule, you can read on here very simply what's happening here between non-resident employees and where their employer is and where you're working, right? These are the basic rules. Those are the states that follow them. And we did pull down one of these cases here in New York. Of course, New York is sticky with respect to anything, right? And in this case, this guy, another computer programmer, this guy actually spent about 25% of his time in New York, 75% in Tennessee. And if you know anything about Tennessee's personal individual income tax, you'll note that it doesn't exist. So this guy was trying to basically say that 75% of his income was related to Tennessee, and therefore he wasn't going to have to pay any tax on that. And New York came in and said, well, no, the only reason why you're working in Tennessee is because you want to do that, right? The employer is not requiring you to do it. So if it's at your convenience, we're going to subject all of your income to New York state income tax. And that's what they did, and they were successful. So it's something that's out there I think everybody should be paying attention to, you know, as you have telecommuting workers.
All right, that was quite a heavy topic, so we're going to move into something a little bit lighter. We're going to talk about what is a domicile and what is a residency in Pennsylvania? What are the differences and when do I need to file in a state? So a domicile is a legal home and a permanent address. You can only have one domicile at a time. Domicile state will tax all income regardless of the state that it is sourced from. And you must have the intent to stay there permanently. And this point is important, and I probably should have highlighted it, but I have a couple case examples that prove that the intent to stay there permanently is very important. Common signs of a domiciled state are your vehicle is registered in that state, your driver's license is in that state, and you are registered to vote in that state. A residency is where one physically lives. You can have multiple residencies at one time. To meet the statutory test of residency, you must be present in that state for more than half of the year. And a statutory resident is taxed on all income regardless of the state that it's sourced from. So we get a lot of questions from our clients looking to retire, to move to Florida or move to another state that has a tax rate, you know, more favorable, or they're moving into Pennsylvania and they ask, where am I filing this year? What state am I a resident of? And there's really no black and white checklist. There's not a certain process that you can go through to establish your domicile and where you file for state purposes, but you know the typical things that we tell our clients are the things that are listed here. You know, register to vote, have your driver's license changed, be there for more than half the year. But I think the reality is that it's really based on facts and circumstances. It's really a gray area, and so even if you do all of those things, the state ultimately can make the determination based on the other facts and circumstances as to whether or not you are required to file in that state. And just a couple examples. So this example, I'm not going to try to pronounce that name, but an individual versus PA. This individual was in 2004. He was going through a divorce, was married all of 2004. He purchased a home in Florida. He worked in Florida. He changed his driver's license to Florida, voted in Florida, had a business address in Florida, received mail in Florida. But he maintained a home in Pennsylvania for his wife and his children, and he spent 50% of the year in Florida, 50% in PA. And he was arguing with PA that he was a resident of Florida. He spent most of his time in Florida. He had, everything registered in Florida. But PA ultimately decided that he was a resident of PA simply because he was financially maintaining that home for his family in Pennsylvania. So, I mean, even after doing all of the things that we would tell him to do, PA still determined that he was a PA resident. And another thing to point out about this case is he didn't have great record keeping when it came to the days in PA versus Florida. So that's another important thing to note. All right, so this case, Southwest Regional Tax Bureau versus Kanya, almost identical facts. So this individual, I forget which tax year it was, but it was an older couple. Again, had a home in Florida, had a home in PA. They spent half of their time in Florida, half in PA, registered to vote in PA, doctors in PA, all of the usual things that we would advise them to do. And in this case, he was determined to be a Florida resident. And if you read the court case, it actually credits his statement of saying, My intent is for Florida to be my permanent place of abode. Simple as that. All of the same facts, but just that statement. And that's why I said, on the previous slide, that is of significant importance. Yeah, but it's really just a gray area. But if you can, complete as many of those items, as we typically suggest, changing your address, changing where you vote, where you go to church, all of those typical things, usually your case is pretty strong.
All right, our last topic just deals with basically dealing with any type of Pennsylvania tax matter and what the process would be in here in the Commonwealth. I would just say that the order, start at the Board of Appeals, work your way all the way up. If you get past the Board of Finance and Revenue, you really have like a pretty serious matter. And in the whatever, how many years, 15, 16 years I've been at GYF, I've only ever seen one where we referred somebody out to deal with an issue, and it had to deal with what state they resided in, Pennsylvania or Florida. To the best of my knowledge, I think that's actually still an ongoing thing. Here's something you might not know. I actually pulled down the instructions. I found this out actually, but I remember this like it was 2013, I believe this is where I learned this. If you pull down the instructions to any of the income tax forms in Pennsylvania, you'll find a paragraph that's some iteration of this. This is exactly what it says. It says the filing of an amended Pennsylvania corporate net income tax report does not replace the filing of a petition, nor does it extend a corporate taxpayer's time to file an appeal. The department is not obligated to revise tax due the Commonwealth upon review of an amended report. Its failure to revise tax due the Commonwealth is not an appealable action and will not change any existing appeal rights of the taxpayer. So what does that mean? If you're going to amend a tax return and claim a refund and think that all you're going to do is mail that into the Department of Revenue and they're going to mail you a check back, I think you should reread that paragraph. Because what you have to actually do in order to force the Department of Revenue to take a look at this is you have to file a petition for refund with the Board of Appeals. If you don't do that, they're not required to do anything. And it does go into great lengths to say that just because you filed that and you may have missed your timing, too bad. This is a slide, or this is a chart that everybody should print out, put it up in their office, because I think it's important. Basically, this is the timeline for filing petitions for appeal in Pennsylvania. Depending on what type of tax matter you have, determines how much time you have to actually file something with the Board of Appeals to get them to take a look at your specific situation. Years ago, I went to a CLE session where someone from the Department of Revenue was speaking, and they provided their contact information. Jokes on them after they did that, because this person was pretty high up at the Department of Revenue. So I would come up with things across time and I'd call this person and I'd say, oh, can you look at this for me? Well, we had one situation where a client of ours claimed that a assessment notice, a Pennsylvania, it was a use tax assessment notice, had never been mailed to them. So if you get this mailed to you, you only have a particular window of time before you have to file a petition here with the Board of Appeals. They were claiming that this thing was never mailed to them, and it went on forever, and then finally, they were getting all these real nasty letters saying that they were gonna, take their property and so on and so forth. So I call this guy from Pennsylvania and I say, client's saying they never got this letter, can you, what's the story here? So he looks it up and says, oh yeah, you know what, you're right, we never mailed this letter. Okay, so it had gone past the 90-day window at this point. We were months past that, so we just decided that we were going to file with the Board of Appeals, and we did that. So I did that, and like a week later, I get a letter in the mail from the Board of Appeals that says, oh, we can't grant your jurisdiction because we mailed you this letter and you didn't reply back within 90 days. I'm thinking, what the? Well, I just talked to literally one of the top guys at the Department of Revenue. Well, their computer system's all messed up. Lo and behold, I'm not even sure if they mailed him the letter, but PA was saying they mailed him the letter. The point is that if you find yourself in that jackpot, that's why it's so important to look at those assessment notices, because if they're assessing you tax, for you to appeal that, you only have 90 days to file that. If you wait past that 90 days, the only way to get back into the system to be able to have them look at your case is to pay the tax on the assessment notice. So that's the one big takeaway. You get an assessment notice, 60 or 90 days, depending on the tax or whatever it is, really you got to pay attention to it. Otherwise, you're going to have to come out of pocket before they'll be willing to hear your case again. All right, so we're the only thing standing between everyone and cookies, right? So I think we're going to get off the stage at this point. Thank you.
Thank you.